Introduction. The 2001 stock market crash was a significant decline in stock prices that occurred from March 2000 to October 2002, also known as the dot-com crash or the Internet bubble. The crash was caused primarily by the collapse of numerous Internet-based companies that had been experiencing rapid growth and high valuations during the late 1990s. The crash had a significant impact on the economy and investors, leading to substantial losses and a recession in the early 2000s. 2. Events leading up to the crash. The dot-com bubble was fueled by the excitement and speculation in the technology industry, with many new companies being formed to take advantage of the growing popularity of the Internet. These companies were often valued based on their potential for growth, rather than their current profitability, leading to a significant increase in stock prices as investors saw the potential for big profits in these new companies. However, as more and more companies were formed and the hype surrounding the Internet grew, the valuations of these companies became increasingly detached from reality. Many of these companies were not actually profitable, and some were not even generating any revenue at all. Despite this, their stock prices continued to climb, fueled by investor optimism and the belief that the Internet represented the future of business. The dot-com bubble eventually burst in the early 2000s, as investors began to realize that many of these Internet companies were overvalued and unlikely to achieve the growth and profitability that had been promised. Starting in March 2000, stock prices began to decline rapidly, with the Nasdaq Composite Index, which was heavily weighted towards technology companies, falling by over 75% by October 2002. 3. Impact on the economy and investors. The 2001 stock market crash had a significant impact on both the economy and individual investors. The decline in stock prices led to substantial losses for investors, many of whom had put their savings and retirement funds into tech stocks. The crash also led to a recession in the early 2000s, as many tech companies were forced to lay off employees or even go bankrupt, leading to job losses and economic instability. In addition, the crash had a lasting impact on the financial industry, leading to regulatory changes and increased scrutiny of corporate practices. Investors became more cautious and focused on long-term profitability rather than short-term growth, leading to a shift away from the hype and speculation that had fueled the dot-com bubble. The crash also highlighted the need for better risk management and corporate governance practices, leading to changes in the way that companies were run and regulated.